Hey, it's Matt Decker with Leveraged Wealth Management. Today, we are going to be talking about premium finance life insurance using indexed universal life. And if you have ever been pitched or sold, or if it has been positioned to you, premium finance as free insurance or insurance with little to no out-of-pocket cost, then I've got news for you. Premium finance, the way that you've been positioned it or the way that it's been sold to you is absolutely too good to be true. So I've got an example here on the screen that I'm going to go through. It is a design that I would consider to be way too good to be true. There are huge red flags all over this, and I've been pretty consistent throughout the last 5 to 10 years in talking about premium finance with my clients, and that is this: if there's one thing in this industry, the financial industry, that you want to make sure you get right, it is premium finance. Because premium finance life insurance policies are one of those things that can really come back and bite you in a place where you don't want to get bit. This strategy involves taking on a bank loan, adding leverage to your plan, and anytime you add leverage, anytime you take on debt, you increase the risk. So if the assumptions surrounding the debt are not done properly, you are set up for a world of hurt. And that is exactly what we're going to talk about today. So what you're looking at on the screen here is a premium finance design for a relatively small premium finance policy. You'll notice that the annual premium, the loan that is being paid out, is $115,000 per year. So that's not huge. It's a total of $1 million over 9 years. Now, what I want you to pay attention to in this one illustration is that nowhere on this illustration, when you're looking at these column headers, nowhere does it say anything about the client's out-of-pocket cost. Okay, now there is a column on here that is going to be the client responsibility, but it's not explicit. So if you don't understand what you're looking at, you could think that this was free insurance. And a lot of times, bad advisors, bad agents are going to pitch these types of premium finance designs as free insurance. And I've got news for you. If you've ever been proposed free insurance, you should run, because it's never, ever free. So let me point out the things that you should be concerned about right off the bat. So number one, you'll notice here that there is no ledger showing the cost of funds. All they've got up here is this one little call out that says loan rate is 4.5%. Okay, now that's fine. The loan rate is 4.5%, but what is it based on? What is that loan rate based on? Is it a LIBOR-based loan? And if so, what's the spread? Is it a prime-based loan? And if so, what's the spread? You need to understand what the loan rate assumptions are based on so that you can determine if those assumptions are indeed accurate. Now, the other thing that you'll notice is there's no actual column in here saying what the forecasted loan rate is going to be for these 26 or so years. Because the one thing that we know about this interest rate is that it's most likely a variable rate, meaning it's going to change every single year. If it's a 1 month LIBOR-based loan, it could change every month. So if you're not seeing a column on a premium finance design spreadsheet showing you what the actual loan rate assumptions are, you've got a really shady design. And that should be required. That should be mandatory. You need to know what that is. This doesn't have that, and that's somewhat terrifying. The other problem that I see with this projection is this column 6, end of year annual interest. It's not explicit. Is the client paying this interest cost? Is this interest cost rolling up in a balance somewhere? Now, certainly you could do the math and you could come to the conclusion that it is or it isn't. You're totally within your right to do that. It looks like it's just rolling up. But it's not explicit, and I hate that about this design. Is the client paying this interest out of pocket, or are they not? The other big one for me is this column 9, cumulative additional collateral required. Look at the way that this collateral starts and how it steps up. So $3,000 of additional collateral is required in year one and potentially $5,200 of interest if the client is paying this interest. They're not explicit about that, so it's unfair to assume one way or the other. What we do know is that someone is taking on debt in the form of $115,000 in year one, and they are only putting up around $8,000. They're putting up around $8,000 to take on $115,000 worth of debt. That's well over 10 times the leverage, and that is extremely risky. That's a ton of leverage. And when you add in the fact that I know for certain that this loan rate's not moving, it's 4.5%. Now, it's hard to calculate 4.5% when you're just looking at this illustration because all they're giving you is a total cumulative loan balance column. You don't know if this is a beginning of the year value or an end of the year value. If this was done right, you would see a beginning of the year value, an interest value, and an end of the year value. We get none of that. But regardless, this is a flat 4.5% loan rate projection. So that's the first problem. That's wrong right out of the gate. That's not the right way to do this. This needs to be forecasted as an increasing rate. The second thing to know about this projection is they're using a levelized rate of return on the life insurance policy that's backing this contract. Now, I happen to know that this particular premium finance design was essentially positioned as free insurance, little to no cost free insurance, because what were they focusing in on? This $5,200 and this $3,000 of collateral. And I know for a fact that if this policy does not perform as illustrated, which we know that it won't, it's going to be different in some form or fashion, but this is walking a razor's edge, because if this policy does not perform as advertised, and if this loan rate moves at all up from 4.5 to even 5 or 5.5, also not knowing what the spread is on this loan rate, we don't know what it's based on. We can't track it, we can't project it because we don't know what it's based on. Looking at this one projection, if anything in this contract goes wrong, two things are going to happen. Either this end of year interest payment is going to skyrocket, which it's already forecasted to increase pretty substantially. So this end of year interest payment is going to skyrocket, and or this collateral column is going to skyrocket. So what happens if we get a zero, and let's say that the loan rate goes from 4.5 to 5, and we get 2 zeros in a row in years 6 and 7? Well, I can tell you exactly what's going to happen. This collateral requirement from the client is going to about double. So a collateral requirement doubles. This was pitched as free insurance, little to no out-of-pocket cost, safe, secure. You're never going to have to worry about it. Oh, and by the way, guess what it's going to do? It's going to generate a huge $398,000 income for the rest of your life, tax-free, that you're never going to outlive. Isn't that the greatest thing in the world? And you paid nothing for this contract. Okay, but the problem is when things don't go according to plan, your collateral skyrockets, your interest payment skyrockets if it's done poorly, and now you're in a position where you can't afford this plan, you default on your loan, and everything that you put into it is gone. Okay, so I would consider this a terrible, bad premium finance design because there's no room for error. This is a design that has to go perfectly in order for it to perform as advertised. And if it doesn't go perfectly, this client's going to be in a position where they're going to have to put a lot of money out of their own pocket into this contract to keep it working. Now, here's what's important about everything that I've just said. Putting money into this contract out of your own pocket is not a bad thing. In fact, it's a good thing. The problem is, if this was sold and if this was accepted under the idea that it was going to be little to no out-of-pocket cost, chances are this is a client, this is a person that should have never entered into a premium finance arrangement in the first place. Because if they don't have the stomach for taking on debt and risk in the form of debt, if they don't have a stomach for a variable loan rate, if they don't understand that over the course of the first 10 to 15 years, their collateral, their out-of-pocket could potentially double based on policy performance, if they're not prepared to withstand changes in these projections, They should have never got into this in the first place. Now, that's not to say that premium finance strategies are bad. There are some phenomenal ones out there. But here's what you need to know about the good premium finance designs out there. Number one, you are putting in way more money than potentially $5,200 and $3,000 in collateral compared to a $115,000 loan. You're not leveraging your dollars nearly that many times. And if you are leveraging your dollars to that extent, you are prepared and you understand that your collateral can fluctuate wildly, and you have cash waiting in an account somewhere to be infused into this contract if it doesn't go exactly right. So I'll say that again. In good premium finance designs, one of two things is happening. Either you are not taking on this much leverage, $115,000 with only an $8,000 out-of-pocket cost in year one. You're not taking on that much leverage, or if you're taking on this much leverage, you have a bunch of cash waiting in the wings if and when your collateral projections change drastically, and you're okay with that. My preferred amount of leverage for these contracts is more like 3 to 1. Meaning, for every dollar that you borrow, you're putting in 33 cents. 3 to 1, no more than 10 to 1. And if you're putting in 10 to 1, you absolutely have cash on hand. 3 to 1 or 10 to 1, and if you're at 10 to 1, you have cash on hand and you are willing and able to up your collateral if and when you need to. So let's recap this way. What are the things that you need to see on a premium finance design? Well, number one, you need to see what the interest rate assumptions are. You need to know what they are, and you need to know what the spread is. Interest rate assumptions and spread, and this needs to be forecasted, meaning it's not a level flat interest rate assumption for the life of the contract. You need to see the interest rate spread, and it needs to be forecasted going forward. It needs to be going up as time goes on. You need to clearly see what is the out of pocket. It needs to be explicitly labeled. You need to understand what it is that you're having to pay out of pocket, and you need to understand how that influences your collateral. And the biggest thing that you need to have on hand if you're going to enter into a premium finance design is cold hard cash. Lots of it. Lots of cash that you're willing to post as collateral if things don't go exactly as planned. And if you have all those things, you understand what's going on, and you have cash to post as collateral if things don't go exactly as planned, these designs can be extremely beneficial long term. If you are not getting the full picture, if you are not understanding and comprehending the risks that are involved, if you don't understand that changes in interest rates, changes in policy performance, all can affect the amount of cash that you have to post as collateral, or the amount of cash that you have to pay out of pocket in the form of interest. If you don't understand the relationship there, you're setting yourself up for a world of hurt. And this is the one thing, premium finance is the one thing you need to make sure you get right. Because if you don't, it can come back to haunt you. In many cases, you are needing to sign a personal guarantee when you take on the debt for these plans. Not in all cases, but in many cases. So you need to make sure that you get this right. So if you have a premium finance policy, if you have been proposed a premium finance policy, or if you are interested in exploring what a premium finance policy might look at, here's what you need to do. You need to go to leveragedwm.com/premium finance. leveragedwm.com/premium finance. What's going to happen when you go there? I'd love to show you. You're going to go to a page and it's going to look like this. There you can see the URL, top left-hand corner, leveragewm.com/premium finance. It's going to go to a page just like this. Is a premium finance policy right for you? You're going to take this quiz. It's very short. It's very quick. Have you already begun a premium finance policy? Yes, I have. Do you understand the risks? Yes, I do. Or no, I don't. What's your goal? Estate planning. Yes, I'm certain it was done correctly. Oh, we aren't the best fit. Why? Because you said you were certain that it was done correctly. In some cases, it's going to tell you that you're not the right fit, and I'll show you. You just saw one. I'll show you another one. No, I haven't started a premium finance policy. No, I'm not comfortable using other people's money. Well, then this isn't the right fit, okay? So depending on how you answer this quiz, it's going to tell you whether or not this is something you should explore further. So if you have a design, if you want to see a design, if you're not sure it was done correctly, if premium finance is something that's interesting to you and you want to make sure you get it right, this is where you need to go, leveragewm.com/premium finance. If you haven't done so already, like this video, share it with your friends, subscribe to my channel. Let me know what topics you want me to tackle next in the comments down below. I really appreciate all the time that you spent with me thus far. I'd also encourage you to check out, if you haven't already, the other 2 videos that I've done on premium finance. I'll go ahead and call those out at the top. It's a great resource in terms of understanding the different risks that are associated with premium finance policies and premium finance designs. This has been Matt Decker, Leverage Wealth Management. Thanks so much for the time, and I look forward to talking with you soon. Take care.